Okay, what's up, everyone? My name is Bobby Taruk with Keller Williams Premier Properties from Team Taruk. Husband and wife team here out in the DuPage County, our small town of Warrenville. Again, with us today is Bill Penley with Caliber Home Loans. Bill?
Hey there, how are you?
I'm doing well, thank you.
Cool. I like your background.
That's why the very messy bookcases and home office. So, hey, Bill, thank you for joining. I appreciate you always joining here. And I'm not sure, I haven't checked the news yet, but have you heard the news what the Fed is doing in terms of the Fed fund rate?
Yeah, that's been the question in the last few months here. All we know is the Feds should be increasing the interest rates. But just remember that does not correlate with mortgage rates. So I think that the misconception that people have with regards to the Feds actually increasing the rates is, does it impact mortgage rates? So what I've seen a lot of times when we hear about the Feds increasing the interest rates is that you see that the mortgage rates have already built in. So when you think about mortgage rates versus the Fed fund rates, you always have to remember that the inflation rate drives that rate higher when the rates are going up. When the inflation rate's going up, you see the mortgage rates follow that. The Feds, if you look at the graphs, and I think I have one or two that I can pull up here shortly. But when you look at the amount of difference between the Fed fund rates and also where the inflation rate is, it's a huge gap. And then the Fed should have jumped on this a long time ago. They didn't. So now we're seeing this big gap that needs to be rectified. And so the Feds should have increased rates probably back in November. They didn't. And now we're dealing with it right now. So the market's actually dictating for the Feds what they should be doing, because the sad part is the Feds don't really have real world experience when it comes to the markets, and you're just seeing a lot of scholars that are driving that. So that's where the frustration for us on the Main Street level comes. But just remember that going back to the initial statement I made was mortgage rates don't have anything to do with the Fed fund rates. It's always the first to react or respond to that are going to be the credit card rates, the HELOCs, and the other types of auto loans and so forth. So just remember that when you're looking at that. So I think we have a very reactionary market when they hear that. I just hopefully can provide a little bit more comfort. And I think that when we see the rates, when the Feds actually do listen, you see the market respond in a positive way with regards to mortgage rates. That's pretty funny.
So yeah, point well taken. I think, including myself, I have that misconception that actually the mortgage rates actually are behind or running behind or driven pretty much by the Fed fund rate. So that's a misconception on my part. And I think a lot of people have that misconception as well. Bill, I want to ask you this question. So just for my edification, probably for the public's education a little bit, what's the correlation with mortgage-backed securities? And if they pay attention to that, is that a good barometer of what mortgage rates will go into or what direction it's going into?
Yeah, so you have two things that are happening here. You have the Feds, which just remember why the Feds were designed. The Feds were designed to increase or decrease demand. So with that being said, they have two vehicles that they can use to increase or decrease demand, either increase the Fed fund rates or put money into the mortgage-backed securities, which drives rates down. The thing that we saw when the pandemic came into play was once again another reactionary market where they just threw so much money towards mortgage-backed securities. Oh my gosh, the sky is falling. Let's put money into the mortgage-backed securities. And that would be this false sense of security that we saw with regards to interest rates. So that's why we saw the mid 2 range as far as interest rates in the last 24 months. But like I said, that's a false sense of security. So what you're going to see is they're going to try to rebuild those balance sheets by pulling back on putting money into mortgage-backed securities. And that's where you're going to see rates rise at that point too. That's why you're seeing rates kind of fall back a little bit. But yeah. So I see you brought up a graph here. Oh, you're on mute though.
Don't go ahead of me. So yes, segue to this conversation. So we were just talking about this in, I can't remember either today, I think it was yesterday's book club and the Chef book club. And it's a very odd situation right now. It's kind of like people didn't realize we actually had a recession at the when we were deep into lockdown and during COVID-19. People didn't realize around April, we had 2 consecutive quarters of negative GDP, which would be the definition of a recession. People didn't realize it. And it seems like it's very weird as well this time around. We still have pretty low unemployment, although I'm reading some of the news and also some news as well from family members that actually layoffs are happening. People are getting furloughed. So, but it seems to me the latest ADP or payroll news was that we still have low unemployment, although granted CPI and inflation are still pretty high. So, but recession is still a very real possibility. We may even be into it right now, and we just don't realize it. Mm-hmm. This graph right here is a representation of where mortgage rates are and during periods of recession. 1992, is it 1992? Early 80s, that is. Mm-hmm. Believe that was also part of, was it Carter years, and then, I'm sorry, early 80s that is, and then during the Gulf War we had early 90s with a recession as well, but more pronounced was in 2008, and you can see in there that mortgage rates actually go down towards the tail end of the recession. So is that the prognostication that what you'll see is that when we go into a recession, that the rates will actually go down?
Yeah. And while you were talking, I was pulling up these graphs to kind of help you see that. I'm just trying to see if I can find the right one. Mm-hmm. But yeah, to answer your question, what I've been telling people, and I'm not a guru by any means, but I listen to gurus like Barry Beebs, Brian Buffini's, people that are betting on the fact that, yes, we are 99.9% sure that you're going to see a recession follow us. If you look at the graphs and how, actually, here it is. Yeah, let me, if you don't mind, maybe.
Yeah, go ahead and share screen. Was this the slide that you were looking for?
Yeah.
This particular, okay, go ahead.
Yeah, no, it's okay. That might be it. But, just to kind of give you an idea, this kind of shows you the history, like you were talking about, where they were trying to catch the inflation. And when they do, you see a dip. This is basically the CPI versus the effective fund rate, right? So when they increase the Fed fund rate, you see a dip in the inflation. And shortly after that, like you mentioned, follows a recession. So if you look at the graphs and how they've caught the inflation, brought it back down, goes back up, and then they increase it, and then you see it come back down. They continually are chasing this to make sure. But the issue is right here. Look at the issue. This is the difference between where we are now versus the rest of the history. We're a huge gap with regards to this is January. So they should have been chasing this a little sooner, right around here back in November. They should have went after it here so it didn't get out of control. Now inflation's out of control and we have a huge gap, probably the biggest in history that we've ever seen in this particular graph anyways, that we need to control that inflation. So once that happens, if you follow the history with these graphs, you'll notice that there is there is a correlation to a recession following that. And I think you'll see a recession follow this as well too. And that's that when that happens, remember when the inflation rates go up. So if the inflation rate comes back down, we see a recession, the rates will come back down. And based on the people that are talking, like the Brian Buffini's and the Barry Habibs that we listen to, they're thinking it's probably going to be the latter part of this year that we'll see a dip in interest rates. Maybe 4 to 6 months, we'll see a lower interest rate. Not what we had before. That's what you have to remind yourself of. We're not going to probably see the 2s or the 3s because that was given to us by the mortgage-backed securities and how much money they were putting into the mortgage-backed securities. So you kind of have this balancing act with regards to mortgage-backed securities and also the inflation and the Fed fund rates.
Yep, absolutely. So this is a slide. I love this slide that I'd gotten actually from MBS, and I've never realized this. And even granted, in the past, I paid attention to financial news. I'm kind of a news geek, but even before we got to the business. And I love this slide because I've never realized that housing actually continues to be strong during recession. This graph right here, let me see if you can see my pointer. There's another pointer that's in the screen grab. Recession of early 90s, recession early 80s, the early 60s as well in the 70s, which was a fuel crisis. But in 2008, that was kind of an aberration, actually. You'll see in here that the index for the Case-Shiller actually dipped during the recession of 2008. Now, the housing market actually crashed the economy. I can't remember, you were already in the business, correct? 2008?
Yeah, I got in 1998, so I was there.
So the housing market actually crashed the economy with just very risky loans being repackaged into MBS, and people were buying these high risk securities and no doc loans, no income verification, very loose lending policies, and that really crashed our economy. So I feel that I share this, and even Dave Ramsey actually says this in a recent program from last week, that actually the housing market crashed the economy and that caused a recession. So that was kind of an aberration. But in here, you'll see the house price index continues to climb, even during COVID in 2020. And then the prognostication is that it will continue to climb, irrespective of us being in a very high risk and probability of going into recession we may already be in recession, Q3 or Q4, or even early Q1 2023. So we go through all this data, Bill, to actually drive home the point around, see what I did there?
I like that.
Point.
Oh, yeah. Nice.
To drive home the point that it's still a great time to buy, primarily because the buyers can always refi. Now, what's happening is that, and I see this as well, is that there's a lot of buyers now pulling back from the market. Their affordability levels, and you see this firsthand, their affordability levels are going down. A lot less buyer pools in the market. Inventory is rising. Still a great time to buy going into probably Q3 or Q4 because they can always refi. Speak to that a little bit, please.
Yeah, probably about 4 or 5 weeks ago, I started kind of having one of those breakdowns. Even though I've been in the business for 26 years, seeing rates rise like this is never a good feel. Never a good feeling. You're like, oh, this is great. I never like to see them go too low either. So I knew that this was coming. It's just a matter of when, But the way that you want to look at this market is prices forever, mortgages are temporary. You've heard the people say, marry your mortgage. Wait, is it marry your mortgage or marry your price? What is it? Date your mortgage, marry your. Anyways, I didn't like that too much. I know people are going to be all over me about that. But I like the fact that you just look at it and say prices forever. Yeah, because that'd be marriage. Yeah. And then dating is mortgages, right? So you're going to be able to lower your interest rate. So my point is, no pun intended, is that I think when you look at the market where we were 3 months ago, 4 months ago, you had 30 or 40 people just crawling all over a house trying to buy a house, and they were willing to get that house at all expense, at any expense. I mean, we saw people that were, giving $50,000 appraisal gaps, which means that house is not appraising out at what that purchase price was. It was actually appraising out $50,000 lower, and they're saying, hey, listen, we still want the house. We don't care. We're going to pay $50,000 more for that. So my manager, Kerry Pastori, is always laughing. He's like, I can't believe people are willing to pay $50,000 more, but they won't buy down their interest rate, maybe $6,000 or so. But I don't think we're in that position right now to actually put that cost associated with driving down the rates because of where we are in the marketplace. So what I've been trying to help people with is, look, right now, yes, you're biting the bullet a little bit on the interest rate, but don't pay points. Points is a percentage of the loan amount. So let's say somebody comes in and they says they want to charge you 1 point for your interest rate. That's 1% of your loan. So 1% of your loan. So if you're at 400,000, that's $4,000 you're taking just to buy down that interest rate. What would happen if you paid $4,000 a day and found out you get 2% lower on interest rate in 2 months, 3 months, or 4 months, whatever that rate turns out to be, and you could get that interest rate for free. So you'd be hitting yourself in the head going, what was I thinking? And I think right now you're looking at a market where you can probably get in with maybe it's not as many multiple offers. There's still multiple offers out there because of demand, and you have the millennials that are still purchasing because rent prices are just skyrocketing. But yeah, it's crazy. But at the end of the day, when you look at buying a house with a mid 5 to maybe even low 6 interest rate, which is historically a decent rate as it is, and not pay extra to get that, then it's a great play in this market. So you're going to be able to get maybe pay list price, or maybe get a couple $1,000s, or maybe $5,000 or $6,000 off that property versus going in and paying extra for it. So I think it's a great opportunity for people to actually purchase, not feel pressured into buying, but actually go out and actually find a really good home that they can afford and take advantage of a refinance down the road.
Yep, absolutely. But you just killed my idea.
Why? What was your idea?
Hold on, I'll get to it.
Oh, I know what your idea is. I think I do, but we can go there too.
Well, let's review really quick. The reality is that home prices are not going down. People are saying, oh, I'm going to wait until the market crashes, or there'll be a downturn in prices. The reality is that the forecast for Midwest, I mean, that includes Chicagoland, is that there will be a 5% appreciation of home prices for this year. That's the reality. So you and I have talked about, and you even have this tool around opportunity cost and what's the cost of waiting. You have that tool.
Right.
That's very real. Those are very real dollars that
Sure.
people need to be aware about. So we totally understand right now is still a great time to buy, and that goes with the home sellers. Now, I want to get to the point of this conversation actually, because there's a lot of conversation going around, at least on the broker's side, around buying points. For the seller would offer to buy points as a seller concession for the buyer. Now, let me take on the legal aspect of this first, because I've talked to a real estate attorney as well around how do we portray this in the 7.0 more purchase agreement. He has some input. I'm not going to belabor the point around that. But the point being is that how viable is it for the seller as a seller concession, not a price reduction, but a seller concession, to pay for points, probably up to a certain amount, to pay for points for the buyer, in essence, to lower their rates. How is that viable from a lender perspective, and what are your tips around that?
Yeah, I think it's a case by case, if the like I just had a client that called and said, how do I get my payment down to 2,500? And they're at 3,000. So if they're, and that's a question I always ask people too, is where do you want to be on a monthly payment? If you start there and they go, well, I'm about $200 off, there's a couple different ways to get there. Either you negotiate a lower price on house, put more down, or lower that interest rate. So that's one way to do it, is to really, buy down your interest rate. When you think about points though, you're thinking about back in the day, like early, like this is before I was in the business, but Dave, my brother, was in the business in the 80s. Points were huge. A lot of people paid points because it was a bigger difference on interest rate at that point. I think it was about 0.5%. A lot of times a difference as far as charging 1 point. So that makes a huge difference on your monthly payment. But now I've noticed that a point is maybe an eighth or 1/4%, depending on the spread on the margins behind the scenes. So it really doesn't make a huge deal of difference. Where I think the market is right now is I think that's an opportunity to, get a nice interest rate. If you have to pay a little extra, I will. Like, I mean, if there's a 0.5%, I'd probably say, yeah, if it's about, because every now and then you'll find a rate that really is got a hedge in there that's got a pretty decent margin where it doesn't charge that, but it's an extra 500 or $600, towards closing costs. So that's not a bad play. But when it comes to like 3 or 4 points, my personal opinion is, put a little less down. I think emergency fund, like going back to Dave Ramsey, emergency funds are huge right now. I'd probably put less down because you do have the appreciation there. You probably will have an opportunity to do a refinance. If we do a refinance and we have appreciation, you might be able to kill 2 birds with 1 stone by doing a no cost refinance and then inheriting a little bit of equity down the road. And then you might be able to get in a different mortgage insurance rate. So there's just a lot of ways you look at it that way. But yes, sellers can pay closing costs. When you're looking at doing that, the percentage of seller contribution is kind of, I think it's twofold there. Well, actually 3 areas. So you have FHA, which is up to 6%.
Okay.
Yep, 6%.
Mhm.
And less than 10% down, you'll have 3% on a conventional. So not a huge amount. But when you put 10% down on a conventional loan, you could get up to 6% seller contribution. So if you had 3 or 4 points, my personal opinion in this market is I'd probably say, look, they're willing to give me 3 points on that seller concession. I'd rather take try to work that in a negotiation. But everybody's different when it comes to case by case. So if somebody's got to get qualified, then that's the only way that's going to qualify them. Then yeah, let's do it.
Yeah. The other piece of this bill, and this is the way I explained it to Joan, because it may be just only $20 a month in terms of a payment delta. But the reality is that if you look at the life of the amortized loan, it could be, let's say, $10,000 saved on interest costs. So maybe it's just $5,000 worth of seller concession. But in the same token, if you look at the life of the loan from an amortized loan perspective, it could be 10 or 15 grand save in interest savings. So it'd be nice, and this, if you don't have this tool yet, it'd be nice to see a table from the lender. If the seller buys down how many ever points, however just the lender allows it, would be give us some data as well on the life of the loan, savings and interest. And I think that's a very compelling argument. If we were on the list side and we coach the seller, hey, the way to up your game in this kind of a market where it's swinging a little bit towards a more balanced market, let's provide a table of savings and net savings to the buyer if we proposition this kind of incentive to the buyer.
Yeah, no,
I'm not telling you what to do, but I'm just saying I think it makes a compelling argument. Hey, these are real dollars. It may be only $20 a month in terms of payment, in terms of savings. It could be even $100 a month in savings, but in the life of the loan, it could be 10 or 15 grand or whatever that number is. And right. The buyer will be like, oh my goodness, let's make an offer in this house. The seller's making this concession.
Yeah, No, I think I think you might see a little bit more of that with this shift to the market. And I think we're on the front end of that shift. You know, I'm starting to see like deals that like this guy that just called me. He goes, oh, I was interested in the property. The property has been sitting for 45 days, and the sellers came back and said, what will it take to get this deal done? That's one of the first I've heard of a seller coming back to a buyer and saying something like that. But I'm also seeing more of that happening right now. Like it's not like you're, having houses sell in 2-3 days like they were. We're seeing, and here's the other thing too. I'm working less on Sunday nights now because you're not waiting for multiple offers to come in, and sellers are sitting and waiting for the highest and best on Sunday. So that makes me feel good. So deals are happening much sooner than what they were 3 or 4 months ago, because like I said, the demand was there. But I think that's, when you get into a market where there is a shift, like you said, a balance, there's a lot of creativity that goes along with that. And I think when you have those options out there and you think outside the box, that means you're a good agent. That means you're working on behalf of your client to get more demand in a market that's trying to reduce that demand.
Yeah, absolutely. We're getting back to the fundamentals as our job function. We're doing more scripts, of course, and just getting the coaching from our coach around preparation as we meet with different clients. So I wanted to share with you this graphic because it really portrays a great story that there's a little bit of seasonality in here. No lie and no sugarcoating. The fact of the matter is that inventory is rising a little bit and will continue to rise as these interest rates are continue to rise. So I think that both buyers and sellers have to be coached properly by their agents, and they need to be coached properly in how, first and foremost, of course, to win the deal, but position themselves to go to the top of the pile. And in the same token, I think that lender partners to be in lockstep with the buyers as well, along with the agents, because even there's a conversation, an idea, masterminding around actually provide the address to the lender partner, crunch all of the numbers, especially if there's an HOA involved, provide the address to the lender partner and crunch those numbers and make sure that we provide the best offer that we can, maybe a higher down payment, migrate from FHA to a conventional loan. So really working hand in hand with the lender partner in essence to really strengthen the offer to win the deal. And I think it takes a little bit more effort nowadays now that we're moving into a more balanced market. The days of, oh yeah, let's call for highest and best offer, given a deadline, okay, let's review the 20 offers, those days are over. And on the buy side as well, writing 11, 12 offers, like what I did experience to win one deal for a client, and it took several months to win that deal. I think those days are over as well. So
yeah,
big shift.
I would say that it could also be a brief pause too, like it could be maybe 4 to 6 months. We see this nice opportunity for a buyer to capture, a home that they don't feel that pressure like they were 3 or 4 months ago. But if the rates do come back down, we run into that spring market, you'll see it kind of turn back on a little bit, and I think that's where, I think that might be the market we see happen if rates do come back down.
Yep, absolutely. So let me end with this, Bill. Any innovative products coming out of Caliber that you want to socialize, please, now is the best time to do so.
Yeah. So yeah, that's like we just talked about, thinking outside the box. 2 products that I've been kind of researching and pulling together our one, we have renovation loans. So we do renovation for conventional, FHA, and then also VA too. So that's a huge deal right now, especially if you have a market like this, where let's say that the property needs to be updated. I just had a client that wants to buy a house, loves it, but goes, man, I'm going to need $100,000 to put into this house. So he's able to get maybe a little bit more off of the price of house. So he actually went in and lowball. That, like, when you talk lowball in this market, you're like, wait a minute, lowball? How are you even getting that across the doorstep without having being laughed at? So he is, and then the seller, believe it or not, is actually coming back and negotiating with them, but they know that they need a lot of work to be done on that property. So we're able to kind of put that in as a renovation loan. And so there's an opportunity there. We also have something called Zoom Casa, which is really, really kind of a creative way. If you wanted to be a cash buyer, you can actually go in and put a cash offer in on a property. What that requires, it requires 20% deposit into the Zoom Casa account, and you can purchase the property. They'll go and buy that property for you with cash, and then you turn around and do the financing with us afterwards. That also, they have one that's called Zoom Casa Forward, which actually, if you have a property that you can't qualify on both mortgages, they'll actually buy your listing from you and put it back into Bobby's hands for him to list it and sell it. But they'll actually buy that, so it takes away that debt from you, and you can actually buy the next property without having to be qualified on both mortgages. It's really a great opportunity for somebody out there.
Yep, absolutely. Thank you for sharing, Bill. I think we're going to end the live stream in here. I'm going to stop the recording as well, but Bill, don't go away yet. You are a captive audience. I will stop the recording right here. Thank you, everyone, for joining. This will be on YouTube. Smash that subscribe button if you haven't subscribed yet to our YouTube channel. Like our Facebook page as well. Like everything.
Like it. Just like everything.
We're on Instagram as well. Hashtag.
Awesome.
Keyword Team Taruk. Like us everywhere. We're all over in social media. So thank you, everyone. Bill, don't go away yet.